Hello, everyone. So happy to have you all here today. I'm Nicole Kittredge, and I'm thrilled to welcome Wendell Butler, who was a very valued team member of ours. And he learned the mortgage industry with me, and I'm thrilled that he is out in the world making a difference. This webinar today is all about private money loans, and typically you hear hard money and you think loan shark. So he is going to dispel the myths about private money lending. And when it comes to knowing about these products, that's one thing. But Wendell has actually, from the time he started working with me a few years ago, bought a condo, sold it, bought a 2-unit, bought an 8-unit, bought a 32-unit, and is now also subdividing land. So he is very experienced in actually doing this type of work. Center Street Lending, who he works for and he's presenting through today, is for investors only. So private money lending for investors. This is not going to be for people that want to buy and live in a home. But with all that said, Wendell, so happy to have you here. Thank you for this quick webinar today, and I'll turn it over to you.
Awesome. Thank you so much, Nicole. I appreciate it. And looking forward to telling a little bit about Center Street Lending. And I also just want to give kudos to Nicole as well. She was one of the best mentors to get into the lending industry I've ever been a part of. I mean, it was the only person that I worked with initially, and I'm glad that I started with Nicole because she really set me up for success to really understand lending and get into my real estate investing journey as well. So thank you so much, and I appreciate you letting me have a little bit of time to talk about some private lending. So yes, so I work for Center Street Lending. Center Street Lending, and our slogan is "Smarter Loans for Residential Investors." That is because we are super flexible, creative, and we think outside the box and don't keep our investors into certain box or guidelines all the time. We are flexible to create a product that really works for both of us, the lender and then the borrower client as well. We do focus just on 1 to 4 unit properties, but we do go as far as large as 10 units for like longer term type loans, rental loans. But we usually focus on 1 to 4 units for fix and flip, new build construction, bridge loans, and then DSCR, which stands for debt service coverage ratio, and those are for long-term and short-term rentals, which I'll dive a little bit into that as we go on with the presentation. So a little bit about Center Street Lending. We were founded in 2010. So we've been around for 14 years, which is a pretty long time for private lending, or what some people call hard money. Usually some hard money lenders and private lenders will hop into the market when it's hot, and then they'll just, do what they can do, lending out money, and then they kind of disappear once the market changes because they can't keep up with the trends in the market. The fact that we've been around for 14 years goes to show our expertise on following the trends in the market, making sure that our guidelines are, 1, safe for us for lending, and 2, safe for the borrower, so we don't have a ton of borrowers running into trouble, or us running into trouble with the loans that we give out. And that just shows that we just have a really good track record. We funded about $4 billion worth of loans over that time, and 1 billion of that, I'm not sure if this counts the 1 billion that we funded last year, but we funded 1 billion total last year, which is crazy, that we have got to that mark. And we're aiming for this year to probably almost double that. So we're aiming for 2 billion. So around 1.5 to 2 billion this year. It really snowball effects and gets going. We've originated over 6,204 loans. And by the time I'm speaking now, I think we've already originated like over 100, 200, 300 plus, the past month and a half. So it just keeps on rolling. We do have a lot of good reviews on Google, which is good if you want to go check that out. Just type in Center Street Lending and that'll pop up. In states that we lend in, we pretty much lend nationally. There are some states here that are grayed out, and it's mainly just because of some more rural areas, and it doesn't fit into our guidelines. But if the deal and the borrower and the experience of the whole aspect of the deal makes sense, we will consider lending in pretty much every single state. It's a little
You
bit,
don't lend in Connecticut?
we do. So everything that's blue there, Connecticut is blue.
It's DC. It looks like that might be grayed out, Melissa.
Yeah,
Mm.
Washington DC, well, even, yeah, it's mostly just Vermont and then Delaware. Delaware has some like municipality problems that make it really hard to
Okay,
private lend there. Um,
I was
but
looking
that's
at
kind of,
states up top. I thought it was in alphabetical order, and I'm like, oh, there's no Connecticut.
oh yeah, I don't know why Connecticut's not there. Oh, it's right there. Yeah, I thought it was alphabetical too. Huh. But it's there. Yeah, because I've already done a couple loans in Connecticut and one going through right now. So as long as it makes sense, we'll work with it, even in the grayed out areas, which is good. A little bit why we're different. So we do express funding for repeat borrowers. So once you work with us once as a borrower, we basically have your application on file. We built a relationship with you, so we understand, your experience, how you like to work, and how we like to work with you. So we can really push the process a lot faster and smoother, which is good. And then obviously we have, tailored experience because you deal with a specific loan officer per the region. I'm part of the East Coast team, so we handle a lot of the East Coast, and then we have a team out in California as well that handles kind of the West Coast, but we can handle pretty much anywhere depending on who you want to work with. And you're not just calling in and getting like a random loan officer to work with. You're building a relationship with that one loan officer and continuing to work with them. We do in-house servicing and in-house fund control. So we don't use third-party servicers to do our servicing, and we don't use third-party to do our fund control for draws for construction and all that. So it makes it very smooth and easy for a borrower to just call in, get a hold of someone if they have questions, get the draws released quick, and get answers to their questions about servicing. And then we just have great communication because which is kind of good because we have teams that are on the California area, and we have teams on the East Coast. So we're pretty much with the two combinations of time zones, we're just available a lot longer than just being on the East Coast, which is good. And again, here's some of our products. So we do fix and flip loans, bridge loans, ground up construction, short-term rental loans, and long-term rental loans, which I'll quickly go over those as well. So fix and flip. Fix and flip, again, we focus on 1 to 4 units. We did get into some 5+ multifamily for some time, and depending on the project, we will still do them now, but there are some trends in the market that makes it hard for exiting out of a commercial property. So we haven't really been lending as much on those, but we do consider it if the borrower is experienced and has a couple exits that they've done and shown that they can do it. Loan terms 6 to 24 months. You kind of decide as a borrower based on your experience and based on the project, what term length you'd like. And we're very flexible on that as well. So we can work with you and kind of decide which one's best for you.
Are these
Um,
full doc?
These are not full doc. Well, they're considered full doc, but not like it's the same as conventional space. So
Definitely, yeah.
we look at the property more than just the personal financial of the borrower. So we're going to look at the property to make sure that the deal makes sense for what they're doing, and then we're going to look at the borrower's credit, liquidity, and then their experience, and we do a background check.
Yeah.
And we just need documents supporting that. We don't take tax returns. We don't take W-2s. We don't, look at all that because it's a short-term loan. So we just want to make sure that they have enough liquidity to complete the project and then exit it. Unless if it is a DSCR loan, we still don't look at W-2 and,
Do they have to
personal.
own a primary?
They have to have an address. So they have to
Okay.
at least have like an address that we can link them to. They don't have to own a primary, so they could be like renting or something.
Great, because I got a couple of investors that, in their culture, it's a lot of multi-generational living. So
Yeah.
they live in a house and it's not theirs. So
As long,
hopefully,
yeah. As long as like on their bank statements, like we can kind of link where they're living.
Mhm.
It works. I did have one person call in that said that he was just driving around in an RV and he didn't have a place that he lived. And that didn't really work because we were like, we need to link your bank to something to just double check and make sure that it's actually like a real bank statement. And prevent more risk, and we can work with it and figure it out, but yeah, they don't have to own a primary residence. Minimum loan amount for fix and flips is 150K. We do everything off of loan to cost for anything that involves renovations or construction. So what that means is we're looking at the total cost of the project. So that would be the purchase price plus how much the renovation is. You add those together, and then we can loan up to 85% of that. There are times we can go up to 90%, and that is if you're a very, very experienced borrower. And then we lend 100% of the construction cost in draws as you complete the
Can
project.
can it be self-help? I
You
mean,
can do it. You can do it yourself. You just have to have experience doing it. We do work with first-time investors. Like if you've never done it before ever and you're trying to get into it, we will loan to you, but we just require that you have a general contractor that we can vet for your first one. And then once you do one with us, it's just a much easier process because you built that relationship with us.
Isn't that great, Melissa?
Yeah, and like I had a realtor that never did a flip before that I'm closing a loan with Monday. He's never done a flip himself, but he's helped investors purchase flips, do the renovation budget with them and then help them sell it at the end. And because he's done like 5 of those in the past, 2 to 3 years, we use that as experience to give him in a limited experience notation, which allowed him to not have to like use a GC. He could do it himself and subcontract because he has that experience elsewhere. So we dive deeper into just you being on a title and you doing the whole project yourself on title. We'll look at like the whole variety of your experience. Especially he had like he grew up in a family that did construction, so we used that as well because he used to do construction with his family. So like why would we not use that experience? We have a little bit of common sense, I guess, when we look at borrowers, which is good. And then the loan to ARV. So we just make sure that we don't have the borrower getting over leveraged going into a property. So we want to make sure that the total loan that we are giving is not over 75% of the after repair value. And that's just to ensure that the borrower will be able to have a profit. And if something does go wrong, and say they have to sell it for less or so, they have that wiggle room to at least break even and make sure that they are good to go to exit. And the minimum FICO score for this is 650. Obviously, the higher the better. The higher the FICO, the better the experience, and then the better the project gives you the better terms. But again, we're very flexible and we kind of figure it out with the borrower, the best terms for them. Any questions on this one?
only question. So if you have an investor that, for the most part, he holds his property, but now he wants to flip, would the holding of properties be considered experience, or you want him to have experience flipping?
So we look at like if he held the property and he fixed it up as he was holding it, we can count that as like kind of a fix and flip in a way. But normally, like if they're just holding it and it was turnkey, every single 2 long-term rentals that they have and have held counts as one flip for us, basically. So that's the way that we kind of look at it. But again, we'll dive like really deep into it and I'll ask them like, have you done any renovations on it? What were the renovations? What were you doing? Do you have pictures of it? And if we can prove that like the kind of before and after pictures that they did some heavy rehab to it, we will count that as a flip, even though it was a long-term rental because they did the renovation portion of it. So that's experience you should be able to use. Any more questions on that? Sweet. All right, and then a bridge. So bridge is exactly how it kind of sounds. It's a quick short-term loan to bridge you towards finding different financing after. So people use this to quickly scoop up a property if it's a a deal that they have to get purchased really quick, but they just don't have time to find the correct financing for it. If their loan maturity on their current loan, like say they're doing a flip or a Yeah, say they're finishing up a flip, but they need like an extra few months to sell the property. You can extend with a bridge, if it makes sense compared to like the extension fees on their current loan. Um, and then it's also kind of like people use this for short-term rentals as well. So usually with a short-term rental, an Airbnb or a Vrbo, you want to have 12 months history of that property performing as a short-term rental, to then get into a DSCR long-term rental loan. So what people will do is buy that short-term rental with a bridge loan for 12 months, show that they have performed the Airbnb over the past 12 months, and then they'll go and refinance into a long-term rental after. Because it's very hard nowadays in the market to find any type of purchase short-term rental lending, because
Right.
it's so cyclical with the short term. Like it's like running a hotel. So they want to make sure that you can do it throughout the whole year. And it's not just based on like expectations or a few months of what you've done. Um, so bridges are probably the very basic, like easiest loans to do. Um, these loans can close the fastest. They can close as soon as like, 7 business days. On average, all of our loans probably close around 10 to 14 days, business days. But bridges are usually the fastest. Loan terms could be 6 to 24 months. Minimum loan value is usually around 150, so 150K. If you're purchasing, it's 75% LTV. If you're doing a rate term refi, it's 70% LTV. And then if you're trying to do a cash out refi on it, like if you have a property that you own outright, but you just wanted to take that cash out, put it into another project or an investment to quickly get that one going, and then eventually find different lending for this, uh, for that property that's getting the bridge on it, it goes up to 65% cash out. Minimum FICO for this is 650, and all of our loans again are interest only. And they're non-Dutch as well, which non-Dutch means that if there are any construction or renovation costs going with the loan, you do not pay any interest on that construction cost until you draw from from your reserves. So that money that's sitting there ready to be drawn from, you're not paying interest on that until you draw it and start using it on the project. And then no prepayment penalties on any of these as well, except the DSCR, which we'll get into. Any questions on this one?
No, sir.
Yeah, this one's really just like, does the appraisal make sense? Yes. Do you have the money to put down? Yes. Okay, let's close it. It's very simple. Ground up construction. So this is what we specialize in, this and fix and flipping. Our owner is a builder that has built over 3,000 homes, I think across like California. And then he came into lending because he saw that there was just not much flexibility or creativity on the lending side for ground up construction and fix and flip. But again, we focus mainly on 1 to 4 units. We could do like, a development project that's like upwards of like 40 units, right? If you're doing like a 40 unit condo, or townhome, but you just have to do it in phases. So you'd have to do like 5 at a time, and then do the next 5, and then do the next 5, and it has to be mapped out that you could mapped out that every property is um, its own tax code and has its own mapping. That way that you can exit by selling it, or you can refinance them individually. Loan terms are 6 to 24 months on these. Minimum loan amount is around 250K, but again, that's flexible depending on the area. We'll look at it and the experience of the borrower. None of these terms are really like very hard set, because we can always make exceptions based on the borrower and the deal and everything. But the loan to
Does this,
cost that yep.
I'm sorry, does this include cost of the land or just construction?
So it depends. So some builders will purchase the land outright and then bring it to us, and that allows them to kind of utilize almost 100% construction, and not have to put any money down except paying like the points and fees and stuff. It really depends on the price of the land, but if they're trying to purchase the land with us, they would probably need to put down like a certain amount. Like for example, for our loan to cost, we go up to 80%. So say the land is $100,000 and then the build cost is $300,000 and they're trying to buy that land and get the build cost, they would have to put down 20% of that $400,000 total approximately. So, but if they buy the land before and then do some work in the beginning, we can credit all that back to them in equity. Like if they spent money to do horizontal work, hookups, soft costs, hard costs, which is like permits and plans and drawings and subdividing, we can take into account all the money that they spent in the beginning to get it ready to build, and then credit that back to them towards the loan to cost to then give them more day one dollars that they basically would have to bring less to the table and not have to put as much money in to get the project started. And then we can give them more construction draw to basically do the rest of the work for them. For the loan ARV, for this one, we do up to 65%. And again, these have to all be non-owner occupied, and then the minimum FICO score here is a little bit higher, so it's 680, because ground up construction is a little bit more of a process, and yeah. But this is the thing about ground up construction. It's every single project is different, and we look at every project in a different way. So the best way to really figure out how we lend and the type of the type of terms that we would give is to run the scenario through with the borrower, so they can understand, because we look at it totally different than other lenders, and we work with them and we find different creative approaches to give them the best product for their needs. And again, this is one thing that's awesome, is we will work with someone that has never built before. We just, again, need a general contractor to be vetted and that they're going to use it. They would be either they would be categorized as no experience, which does give more expensive terms. But if the general contractor is willing to personal guarantee the loan in the project, you can then use their experience to give them better terms, even if the borrower that's handling all the finances and getting the loan doesn't have the experience. We can use that general contractor's experience. Any questions on this?
No, so basically it's for somebody building a house and then they're gonna put it up for sale, not
Yeah.
build it and keep it. If they're gonna keep it, they've got to find other financing after 2 years.
Yep. Yeah. Like
Yeah.
I work with a couple clients that only build and hold, so they build to rent. And ways that I work with them is, we can look at the exit numbers of what they think the rent's going to be based on their experience and based on the market, and then we could set them up to just refinance into our DSCR product right after, so they could stay within house. So it can kind of be like ground up construction, and then once it's almost finished, we start working on that DSCR. So once it's done and the tenants are in there, they can then hold it long term. And then other ones obviously will sell it as well. So it just depends on what the goals are, but we don't force them to sell it. We just have to make sure that it makes sense, and it'll work.
Nice.
Yeah, the biggest thing is, like, we do want to make sure that, because worst case scenario, right? Like if you build it, the easiest out is to sell it. So we want to just make sure that there's not over leverage. That's why we look at the LTARV of 65%. So worst case, if they can't refinance it after, or they're having problems with it, they could always sell it. So we make sure on the front end that the borrower will not get caught up at the end. And that's why we do a lot of like front end kind of due diligence and really crunch the numbers instead of just pushing the loan through and then figuring it out during the process. We want to keep our borrowers safe so they keep coming back. Short-term rental loan. So this is basically the same as like a long-term rental loan. So I'll just go right to the long-term. We just kind of call it short-term because we can do it for Airbnbs and stuff. But long-term rental loan, which is DSCR, is very, very similar. Again, we could do 1 to 4 units. These ones we can go up to like 10. So 10 units, if it's a 10-unit multifamily, we can do that. We do loan terms up to 30 years fixed. We can also do 10 years interest only. It then turns into 20 years fixed after for principal and interest. Minimum loan amount is 100,000. Cash out refinance on this can go up to 75% depending on like what type of property it is and your credit and your experience. And then to purchase the property, we can go up to 80% LTV. And the minimum FICO for this one is 640. So this one is mainly, we look at how the property is going to perform with a DSCR calculation, so debt service coverage ratio. We don't look at DTI, we don't look at anything like that. We're just going to make sure that the rents coming in that are currently in place or the market rents combined cover the PITI, so the principal, interest, taxes, and insurance, to an amount that allows, us comfort to provide the loan. We can go as low as 0.75, so 75% of the PITI, if the gross rents are hitting that. I wouldn't recommend it because those terms are probably not really good. But the best terms come when it's a 1.15, so 115% above the PITI. So with that being said, like if it's $1,000 for your total PITI, if the rents coming in are $1,150 and higher, that's going to give you like the best terms, but we can go as low as $750 for $1,000 PITI. And the reason people do come in with like the low 0.75 DSCR is because they know they're going to stabilize it, or
Right.
or it allows them to quickly, purchase with a long-term rental aspect when their real goal is to Airbnb and Vrbo it. So we can't use Airbnb and Vrbo numbers to purchase,
Right.
but we can use long-term rentals to at least get them the loan. But then if they know that they're going to make a lot more money with the Airbnb and Vrbo numbers, they're comfortable with it because they just want to get into that long-term rental loan as soon as they can.
And with the multifamily, I'm assuming that's something over 5 units and up.
Yep. Yeah. So 5 to 10 units we can do. When it gets over 10, we sometimes can do them, but it really depends on like how strong the property is. And then that changes with the market. So like we really pay attention to the market trends and the banking systems and what their appetites are for exit refinances and purchasing. So the commercial market right now, it's a little more difficult to buy 5+ unit multifamilies and also refinance them. And we know that. So we just want to make sure that anything 5+ is super strong. That way, worst case, if they have to refinance or they're trying to sell it, the property will be able to refinance and sell. And then we do Airbnb and Vrbo. Again, we can only use the Airbnb and Vrbo rentals if you're doing a refinance and have like a 12-month history of it. Otherwise, we look at it with market rent if you're long-term market rent if you're purchasing it. But yeah, we have the ability to do that. And then for loan terms too, we do ARMs. So we do a 5 to 6 ARM and 7-6 ARMs. But those aren't as popular currently. It's more just people looking to get into fixed, and the interest only, the first 10 years interest only is a great factor, because if you're looking at just cash flow for these long-term rental loans in the first 10 years and know that it's going to appreciate and maybe want to sell it after that, and that's your plan, then that's a perfect opportunity to use that loan. And then we do have prepayment penalties on this. The normal prepayment penalty is 5, 4, 3, 2, 1, but you can move that around by paying additional like points or fees to get it lower, or to take it totally off. So DSCR has a ton of moving pieces, and we can kind of cater it to the best loan type for the borrower of what they're looking for.
Okay.
Sweet. Any other questions on this? Awesome. All right, this is just kind of summarizing why the benefits of working with us. So again, one thing is same day quotes. So if someone reaches out to me, or a borrower kind of has a scenario, I can get them a quote literally in 5 minutes, as long as I have all the numbers needed. The minimal documentation is huge because it makes a very smooth, easy process for the borrower, especially once they work with us once. It's like an express funding. They get put in like the express funding kind of application system where we can use their past documents and applications and experience to kind of just push it forward and go really fast. Another big thing is, yeah, we close as quick as 7 days. I just had a loan close in, I think, 6 days, 6 business days, which was pretty fast. That was a fix and flip loan in Florida. But that involves just everybody working together. So need the borrower to get me all the documents, need the title and escrow to get me everything, need the appraiser to come back with a good appraisal pretty fast. As long as everything lines up, we can close pretty fast. And then all our fix and flip and bridge and new build construction has no prepayment penalty, except the DSCR does. And then the non-Dutch interest is huge, because if you have a large renovation scope, you don't have to pay any interest on that money until you draw it, which saves you a lot in the long run of the loan. Here's just some customer testimonies. Again, we have a ton of Google reviews on Google, so it's nice just to look up and see kind of what we do and how people like our process. And that's pretty much it.
Awesome. Our goal is to get Center Street Lending added as one of the brokers we refer out to. So that's what we're working on. Hopefully we have
I mean,
success there.
I mean, they have some really unique products. I think
Yeah.
it definitely would be a great addition because
And they're in line with us as being servicers as well.
yeah,
Yeah, we're very, I would say we're very transparent, which is good. Like when a borrower
I'd
brings
say.
us when a borrower brings us a deal, like we'll let them know like this is a good deal, and we actually like on the phone with them, we'll look up like the property comps and things like that. We'll look up market rents with them, and we'll kind of tell them like this is a good deal. Actually, let's move forward. Let's work on this. But if it's not a good deal, we'll let them know. And sometimes borrowers get a little huffy and puffy at that, but we're so truthful and transparent and have like an investor, experience and investor minded that borrowers usually like that because we save them sometimes. We save them time, we save them
Definitely.
money. And then yeah, it's a lot less like some other private lenders might be a little more just talk about terms, talk about let's do this, push them through, and then they can't get it done. We want to make sure it's all upfront. We all get to know each other up front and see if we can really work the deal.
I
So.
love that. So it sounds like people can call you 7 days a week, Wendell. Would you agree?
Yeah, absolutely. I mean, real estate is never takes a day off. So.
Thank you so much for this.
thank you. I
You're
like
welcome.
it.
Thank you.
I hope we get you on board.
Me too.
Yeah, that'd be awesome.